Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, September the 21st. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, let's get it on. Across the pond, not really any economic data. We do have Mario Draghi speaking, which is the ECB president, which is the European Central Bank president, and probably talking a little bit about monetary policy as we had our FOMC yesterday, and Janet Yellen and crew decided to not increase interest rates. Now, a little bit inside of what that after they released that they weren't going to increase interest rate, Janet Yellen seemed to be a little bit hawkish. Now, you'll hear these terms thrown around when it's coming to monetary policy, and dovish means that they are going to be more accommodative, which means lower interest rates. Hawkish means that they are going to increase interest rates, kind of slow down the economy. Now, if you remember last week here in the United States, we got PPI, producer price index, we got CPI, consumer price index, we've had some retail sales. None of those have been showing a whole lot of robustness, and we also started getting some wholesale inventories, things like that, industrial production that were lower than what was expected. If you remember, PPI came in at 0.2%, was expected to be 0.3%. Core PPI came in at 0.1%, was expected to be 0.2%. CPI came in at 0.4%, which was slightly higher than the expected 0.3%. Core CPI came in at 0.2%, in line with the expectations. Remember, CPI is consumer price index. And industrial production came in at a negative 0.9%, a full percentage point below what they were expecting. So all of those numbers don't really show robustness, so I'm a little bit in a conundrum here as to why they were speaking a little bit hawkish. But we will also tomorrow start getting out some flash PMI numbers from across the pond, French, German, and things of that nature, and Draghi speaks as well. So just keep all those things in mind. Sometimes, the Fed governors, especially as of recent, don't seem to be really in touch with what's going on in the economy, because they had to have that economic data before they went into this meeting. It was a full week ago. It wasn't like it just came out the day that they were releasing the interest rates. So anyway, on to the United States, we have unemployment claims came in at 259,000, expected to be 302,000. And Philly Fed manufacturing did ramp up a little bit at 23.8, was expected to be 17.3. So that's one of the few numbers that we've seen on the manufacturing side that has been better than expected. So, and they wouldn't have had necessarily access to that economic data. They may have, but I doubt that they did. Anyway, on to the overall. Oh, and one last thing was natural gas storages came in line with expectations, slightly higher at a 97 billion cubic feet, expected to be 93 billion cubic feet. So slightly higher than that. Anyway, on to the overall markets. We've got crude oil unchanged, but in that $50 barrel area, and I've talked about this many times. Crude oil being above 50 is good for ConocoPhillips, ExxonMobil, Chevron, Anadarko Petroleum, things of that nature. As a matter of fact, they really popped today. So crude oil being up there is good for those guys. Then on to gold futures, it's negative on the day, as one would expect with the markets at all-time highs, and don't really expect any accommodation. When you start seeing the accommodation dovishness speak, that would be a flight to gold in a sense. But when we're starting to be hawkish, I don't think that you're necessarily going to see gold really blast off. But one thing to note, we do have gold below that $1,300 a barrel, or $1,300 a troy ounce, area. So it has broken below that 1300 line in the sand, which is a big psychological level. Support resistance, as you can see, it's acted that right along here. It acted as resistance back, in Jan, Feb, March, April, and May. Now it's going to be acting as support, which it did. It just so happens to line up with the value area high, but we are below that area. So the bears are taking control of that market. All right, on to the bonds. Bonds up slightly. A bit bizarre. You hear Fed governors talking hawkish, which means increasing interest rates, and it's kind of like the teeter-totter. You increase interest rates and the bond prices go down. You vice versa, increase or lower interest rates, bond prices go up. So it's kind of a teeter-totter that way. They act back and forth. Interest rates going up, bonds should go down. For some reason, bonds are starting to move up. So go figure. And it could be slightly because the overall equity markets are slightly negative on the day, but that's not showing up in the VIX. VIX is still in negative territory, continuing to go down and back into the nines, the single digits, if you will. But here's what I was talking about with the equities. We have the Dow Jones Industrial Average down 23 points, which isn't a whole lot, but did make a new all-time historical high today off the open. NASDAQ down probably the most in terms of percentage, down 26 points, almost 27, and they've been the real laggard, despite the fact that we've seen some technology going up. Things like Adobe, Intel, and Apple. Apple is a major reason. It is the highest weighted in the NASDAQ, so Apple really pulling down the NASDAQ quite a bit. The reason why Apple's down is because there's a lot of problems with the iWatch 3. People aren't really satisfied with it necessarily. It does, one nice thing is it finally caught up with like Samsung and things of that nature, where you don't necessarily have to use the Bluetooth technology to talk to it. Maybe people are starting to realize that Apple's just putting lipstick on a pig like they've always done, because Samsung's had this watch out for probably 5-6 years where you didn't necessarily have to have your phone next to you within 10 feet in order to work that apparatus. So Apple finally doing that. They're well behind the curve on technology. I've always said they aren't innovators, they are copycats in a sense. So maybe people are starting to realize that a little bit, that the products they're putting out are not nearly as nice as what is out there already. And then the E-mini S&P's down just 3 ticks for all intents and purposes, unchanged, still above that 2,500 level. Now, on to things that are actually, let's go to the breakdown. This is what I was talking about on the hawkish statement from the FOMC. We really got a sell-off in the E-mini S&Ps. The market rebounded quite nicely, maybe because they were sloughing off what they were saying as just rhetoric. Then overnight really kind of consolidated off the open. Economic data points slammed down and are now rebounding. It's just like Teflon around the equities that they just do not want to sell off. Now, what I've done in my IRA, it's getting a little bit short deltas, and I'm going to put some money to work in there. I haven't done anything in my margin account, but in my IRA decided to add something. I have found Kellogg as the thing that I could be most bullish about, if you will. I don't think people have stopped eating cereal and things of that nature, and the staples have really gotten beat up. So I decided to go in here. It looks like there's basically a double bottom here, right down here at the 63.70 level. A little bit early maybe, but I think that this is a pretty good sign that we've kind of bottomed out here. Also heading into an earnings, I think that we're going to see volatility expand, so I thought it was the right time to add on some long deltas with a long call spread. So I went into the November and did the Kellogg very small, keep in mind, because it's not really a confirmed to the upside at all, but I went in and did the November, and I bought the 60 calls and then sold the 70 calls in there. As you can see on the earnings, they have a tendency to beat the street, and there's a lot of bearishness heading into their earnings for some reason, but you can see that there's usually a bounce somewhere right around this time in their earnings cycle. They always have a tendency to be real bearish heading into it, hit their earnings and blast off to the upside. So that's what I'm looking for, and that's why I went into the November, get that expansion and volatility, hopefully get a bounce heading into that, heading into that earnings season. So I'll be able to recoup some of that. So recoup some of this gain here, and the 70s just happens to line up with the value area low, so that'll act as resistance. So I'm thinking that might be able to be a nice little target for it. All right, so that's about all I got for you guys today. Tomorrow's webinar is going to be on the short strangle. It's going to be a really good one. I know you can go online, figure out how to do that online, but I'm going to have certain rules in and around that environment and show you the right strike locations to increase your probabilities of success with that strategy. Okay, so if you can't take that, take it easy.